This is Mastering Your Wealth with David Gagnon, the podcast.
You know, making your life financially work when the paychecks stop. Okay, that's something that we can all kind of work towards and use different, strategies and vehicles, as we say here in retirement planning, to make that happen. But there's also a couple things we can't control. One of those being a possible recession. And we've been hearing that word a lot lately with some recent volatility. Market Watch interviewed 6 financial professionals and asked them, if you're worried about a recession, what should people be doing? Here's some of the things they said to consider. Number 1, build up cash reserves. Number 2, pay off high interest debt. Number 3, consider adjusting your risk by rebalancing. And number 4, don't try to time the market. And lastly, at number 5, stay calm. David, what are your thoughts on this?
Well, I'll tell you, having cash reserves, I think, is pretty important. When you look at what's been going on in the last year or so, we've been seeing bank failures, right? Mm-hmm. And if you happen to be in a bank that has your cash, you may not be able to access cash right away. So it's good to have some cash on hand just in case. There's more and more talk about bank failures. Well, who knows? But you should have cash as a backup. Paying off interest, high interest debts, or any debts that are affected by these movement in interest rates. Just don't want to get into retirement when you have a lot of debt still on the books. So it's nice to put a plan in place to get out from under that debt before you retire. Now, rebalancing your portfolio. Yeah, it may reduce some risk, but, that's just such a vanilla type investment approach and strategy. For instance, back in 2022, if you remember the markets, both in the bond markets or the bond fund markets, bond mutual fund markets, and the stock funds, a lot of people have a traditional allocation in mutual funds of possibly 60% equity funds and 40% in bond funds. And people feel that because they have an allocation in the bond funds, that's kind of their stabilizing factor in their account portfolio value. But what happened back in 2022, not only did the equities go down significantly, the S&P was down over 18%, the NASDAQ was down over 33%, but the bond funds lost money because those bond funds were holding bonds that were purchased over the years at low yields, and the interest rates in the bond markets went up. So those bond values dropped at the same time that the stocks did. And if you had rebalanced that portfolio with that type of an allocation, maybe you would have lowered some of your losses on the equity side, possibly, but people lost a lot of money in 2022. Mm-hmm. And so what we do is we do things differently. We look at incorporating different management techniques and tools and strategies and product types so that we put airbags on that money and think outside the box and how you can invest your money differently to lower your risk, increase your returns, and have buffers on that downside so you don't suffer the big drop in the market like everybody else is experiencing, because we're employing different tools and techniques and hedging against market drops. And we do this with professional tactical money management or different investment tools and products that the insurance industry provides, where you can have your principal protected but still participating on the upside of the market. And so if we do things in that respect, we can recession-proof a portfolio or market-proof a portfolio with the right management approach. And we get to the right place of how people should invest their money in the right tools and the right investment product strategies by doing a plan first, because we want to see how much of a yield that you need to generate based on how you're saving your money or how much you'll have at retirement. And also we incorporate tax planning. Tax planning is big in looking into the future if you set it up correctly, because we want to be tax efficient. If we reduce taxes in the future, you don't need as much of a gain to get a better net result or take as much risk, because you're overcompensating for paying more than your fair share of taxes. So with good planning on the tax side, we can build a very solid plan on the investment side, incorporating a lot of different moving parts in your financial world, where we're mitigating unnecessary cost, unnecessary risk, and getting better and more consistent results with less volatility. So rebalancing, if you're in a traditional portfolio, that might help over time, but you're still at the mercy of the markets, the interest rate markets if you're in bond funds, and the stock market if you're in equities. So I think having a plan first, which I don't see people coming in with plans. Mm-hmm. They have investments, and those are just tools. And they've been investing their money in funds and stocks and bonds, and they really don't know if that's really the right place for the money, and they don't, because they don't have a plan.
Right. And also, just back to the plan thing, everyone thinks they have a plan when it's in their mind. That's not the plan. The plan is written down in black and white, shows you different options, A, B, and C, et cetera, right? I mean, just going, hey, I have this money, this money, this money, that's not a plan. No,
those are tools. And, your investment decisions and where you put your money should be the very last thing you do, because you want to have a plan first. When you are building a house, a brand new home, and you're going to dig that hole and put the foundation in and build and frame and finish it off, you don't start buying materials or, determining, what types of fixtures or any of that stuff you're going to have until you have a plan. And
right.
Then when you have a plan, from the plan specifics and the details of that plan, you'll know exactly how much concrete you're going to need, how much lumber you're going to need, how much paint and carpeting and wood flooring or whatever you're going to put into that home. And when you do it that way, you lower your risk substantially of not getting what you really want the outcome to look like in that home. Same thing with your money. You should really have a plan. Mm-hmm. It should be strategic in your own personal goals and objectives. And, it's important to start with a methodical process, and the details of the analysis that we do will identify what types of benefits you need to have available throughout your retirement many years before you get there, because we need to know how much you need to save, what rate of return are you going to need, how do you build a tax strategy so that you're lowering your tax bill in retirement? How do you have a healthcare backup strategy if you have the event of needing out-of-pocket healthcare? So, you can see there's a lot of moving parts in planning and making financial decisions. So, if we are looking to recession-proof anybody, we encourage them to give us a call. Let us put together the comprehensive analysis just to see if what they're currently doing is going to work out, or what kind of areas are they vulnerable in with the stock market, or do they need to really employ different tax planning approaches so we can reduce their taxes?
David, I think I mentioned this just about every show, that you've been doing this nearly 40 years. You've been doing this for a long time. So you've been around through recessions, through elections, through different changes to our taxes, et cetera. So what makes you different and stand out? What makes your strategies, your goals, all that kind of stuff stand out than the other guy down the road?
Well, I'll tell you, my background's pretty diverse. I came into the industry as a CPA. Been doing a lot of tax work over the years. Earlier on in my career, I still continue doing advanced tax planning strategies, because one of the things that you can really utilize in your back pocket to gain more wealth and take less risk is to find ways to reduce your taxes by using the tax code correctly. Integrate that with the financial world. And that is, I think, an invaluable background to have when it comes to long-term planning for folks. So I started out working in the CPA professions, designed and grew my own CPA firm. We did a lot of business accounting and financial reporting, tax preparation, tax planning. And then I realized, knowing what I knew and seeing some of the mistakes my clients were making that were in the financial planning area, working with other folks before I actually did comprehensive planning, they were making some costly mistakes in the things they were investing their money in and how they were paying it and getting charged in taxes unnecessarily. So I decided that it was better for me to sell my tax and accounting practice and focus on comprehensive planning, which I did back in 1990. I got all my licensing and then sold my tax firm and been doing comprehensive planning since that time. And so I've had the experience of seeing so many different cycles occur in the stock market, the economy, the tax law changes, and working with so many folks over the years to see what was working for folks and what wasn't, and some of the common mistakes people make over and over again in employing the right financial strategies and actually doing planning. Because you really have to do financial and tax planning that's personalized first. And when you get that plan design in place, then the details of all that analysis will help identify how you should invest your money, in what types of investment tools and strategies, and also what tax types, because you want to not only be investment diversified, you want to be tax diversified. And overall, we're trying to create, what I try to do as an advisor is build so much value, way over and above whatever I could get paid, because we want to help people get the most out of all their resources by making good financial decisions. And it comes down to making good decisions with your Social Security claiming, your pension, your income distribution planning. And you can just see the list goes on with financial decisions that you want to make good in all those areas.
Now, if you retire with a 401k, the question usually becomes, what do I do with it? There are generally two choices. You can either leave the money in a former company's plan, or you could roll it over to an IRA. So, David, what should we know about each option there, and which one do you usually recommend to clients?
We always evaluate a client's 401k plan, especially when they get into retirement, or even before retirement, but more so when they retire. We have to determine if the 401k is the right fit, especially when it comes to income planning. 401k is a great accumulation tool, because what happens is people can set up a systematic monthly savings deposit into their 401k. And today you might even have a Roth 401k, so you can kind of start building up a tax-free portion of your retirement. And if you're young, I highly recommend those that have a 401k Roth to really consider trying to amass more money in that area. But the 401k is great for accumulation. But when it comes into retirement, it's tough to really put together a great income distribution plan, because most of the investments in their investment options are bond funds and stock funds. But when you have an income plan, we're using income generating tools that are much different than bond funds. And so we'll take a look at how do we improve somebody's long-term and income distribution strategy by trying to see if it can be accomplished using their 401k options, and how can we do it differently and improve the results in getting higher yields, getting consistent income, getting predictable income, and keeping risk at a bare minimum. And so when we start looking at how do you make improvements of what you're currently doing, we do a portfolio analysis just to show folks, if you're making a change and you're going to have us work on your investment strategy, how does it compare to what you're currently doing? Because what we'll be able to show folks is how much risk we're reducing, how much yield we can create, how much cash flow we can create that the 401k just can't do. Now, here's a great opportunity. If you have a 401k plan, and if you're over 59 and a half, most 401k plans will allow you to do what's called an in-service rollover to an IRA, which opens up the entire investment world for that money to do things differently, to get better results, possibly with higher yields, lower risk, lower fees, and better investment management. And so we do a lot of those in-service rollovers, because once we educate people on the better alternatives that you can find outside of the 401k, it just creates better value and opportunity for those folks with that 401k money in a self-directed IRA. Here's the other thing. If you retire younger than 59 and a half and you have a 401k, this is something you got to be very careful about before you move that money into an IRA.
Okay.
If you terminate employment with an employer and you're age 55 and you have a 401k plan balance, you can use that money if you leave it in the 401k for income, and you can start taking distributions without the early 10% withdrawal penalty the IRS will typically charge you with if you had that money in an IRA. So what I see often are folks that retire younger than 59 and a half. They have some investment person that they are working with that rolls their 401k out before determining whether they really need access to that 401k to supplement their income now that they're retired. And if they had moved that 401k into an IRA, now they're subject to that 10% early withdrawal penalty if they need money. So you have to be really careful before you transfer that 401k into an IRA if you're younger than 59 and a half, because what we always do is we look at the income planning needs before 59 and a half to make sure that if that 401k is their only resource to supplement their income, we're going to have them leave enough money in that 401k to provide that income so they don't get hit with the costly 10% IRS early withdrawal penalty. So that's something that we see a lot, unfortunately, and it's because either, the investment person they're working with didn't know about that rule, or they did and they just didn't really advise the client appropriately. So if you're really struggling to determine if your 401k is the right fit for your investment planning and your retirement needs, give us a call. Let us do that for 401k plan analysis and show you whether that's the right fit going forward, or are there better opportunities outside the 401k plan to improve your long-term results with better performance and lower risk and lower fees.
Now, I want to jump to this. I know this is a question literally everybody has, right? You want to know, how much money do I need to save for retirement? Is there some magic number that I need to finally get to? Well, according to the government, expenses for younger retirees, and we're talking 65 to 74, amount to nearly $4,900 a month. For those 75 and older, it goes down to about $3,800 a month. So a lot of that can be covered by Social Security, meaning that, you won't pull much from your IRAs or 401ks. So does this create a problem when it comes to taking RMDs? So a loaded question there. How do you know how much money you need? How do you know if Social is going to cover it? And then, of course, you got RMDs factoring in there as well.
Well, you have to model that out with what your resources are that are available to you and your spending requirements adjusted for inflation and taxes. I mean, this is what we do when we do our complementary forecast analysis. We need to kind of take a high-level review of what the numbers look like going years into the future. And this will identify, how much income you're going to need to generate and how much your Social Security will be able to satisfy some of that income need and goal. And then really, it's important to evaluate when you really should take Social Security based on your family situation. If you're a married couple, we always do a Social Security comprehensive claiming analysis, and it's all tied into life expectancy that will identify when each spouse should take their Social Security based on the amount of income they can generate combined based on how long they think they're going to live. So that report is so important because we can help people avoid costly mistakes and possibly claiming their Social Security too young. The common thread we see when people retire is people worry about replacing their paycheck. They're no longer working. They need a paycheck to cover their bills. And the first thing that they look to do is turn on their Social Security without any thought to whether that's the right thing to do at that time. And so when we show people that in many cases it's better to defer taking Social Security, then their next question is, well, where do I get my income? And so we show people how to design and we structure a strategic income distribution plan with their other resources. So if it's retirement savings or brokerage accounts, we can show them how we can create that income that gives you the luxury of deferring your Social Security so later you're going to get more. But we know how to fill that income gap with the right tools and the right strategies to allow you to do so, because this is something that the decisions you make should be rational and logical based on the details of your own personal analysis, not based on emotions or assumptions that you don't give any clear thought to as part of an overall plan approach. But the thing is, we also stress test forecast assuming Social Security benefits might get reduced. We hear a lot of talk about Social Security not staying afloat. And that could be a real possibility going out to, they're projecting around the year 2033, 2034, they might have to reduce benefits by 20 to 25%. So that is a big drop in an expected resource in the future. So we want to see if your plan can really absorb that and your other resources can pick up the shortfall. And it's good to go through this exercise now, because if that were to occur and everything looked good without any reductions in Social Security, but in fact they do happen, you're going to have to make some very big decisions or spending decisions and adjustments so that you can make sure you don't run out of money. And
that's the big concern, right? Running out of money, yeah.
Yeah, and it's a real problem that I see over and over. People are running out of money because they've miscalculated what they were planning on or needing to spend in retirement, or miscalculated on how much they need to have saved in retirement. And when inflation goes up, it gets very challenging to make this money last for as long as you think you're going to be around. And so we always want to stress test various different assumptions, and we take a look at situations where, Social Security may not even be there. When we work with younger folks, we don't even factor in Social Security in their planning. And if we do it that way, and Social Security does exist when they do retire, then they're going to have a lot of excess availability and more wealth as a result, because they saved more earlier on in their careers. So you can see there's a lot of uncertainty out there, but we need to plan for it and look at different scenarios of how do we fix the problem if things do change, especially if Social Security is reduced. So if you really want to get some feedback on how to put together a planning approach and evaluate all the different moving parts and try to get you on a path where you're saving at the right rate.
For more details or to sit down with David for your complimentary financial GPS, visit masteringyourwealthradio.com. David Gagnon is an investment advisor representative of Retirement Wealth Advisors, LLC, an SEC-registered investment advisor. First Financial Planners, Retirement Wealth Advisors, and WICC are not affiliated. Exposure to ideas and financial vehicles discussed should not be considered financial advice or a recommendation to buy or sell any financial vehicle. Individuals should consult with a professional specializing in the fields of tax, legal, accounting, or investments regarding the applicability of this information for their situation. Past performance is not a guarantee of future result. Investments will fluctuate, and when redeemed may be worth more or less than when originally invested.